Hello, this is Michael Schiff, and today I am going to explain what capitalization rates are in the world of commercial real estate. If you're in the world of commercial real estate, either buying or selling an investment piece of property, that's a property that's obviously producing income, then you're definitely going to hear the word cap rate. People are going to say, what cap rate did you buy that property for? Or what cap rate did you sell that property at? If you were to look up the definition of a cap rate and how you arrive at a cap rate, you'll get the boring definition that's probably going to confuse you. And it's going to tell you that you arrive at a cap rate by taking the net operating income of the property in the first year and dividing it by the sale price, and you're going to get a cap rate. And it's basically a yield on your investment. However, that doesn't really help you understand why we even use cap rates in the first place on income producing properties, and why you would use a higher cap rate versus a lower cap rate, and how all that's determined. So that's the purpose of this, and I'm going to show you a real world example of how we use cap rates in commercial real estate. So let's use this example. We have two properties that are located on the same block. They seem to be identical in just about every single way. Let's say they're the same size, the same annual gross income, the same annual expenses, and therefore they both have the exact same net operating income. Would you pay the exact same price for both properties? Before you answer that, let me tell you what's different about the two properties. The one on the left has 3 national tenants and is a much safer investment than the one on the right, which has 3 mom and pop tenants. Obviously, national tenants have better credit and are a much safer investment than mom and pop tenants. Therefore, the one on the left is going to sell at a much lower cap rate, and the one on the right is going to sell at a much higher cap rate. The correlation between the cap rate and the price work opposite each other. The lower the cap rate, the higher the price. The higher the cap rate, the lower the price. The easiest way to remember it is that the correlation between cap rate and risk go hand in hand, meaning the higher the risk, the higher the cap rate, the lower the risk, the lower the cap rate. So if you were to buy an investment property that, say, had a Home Depot or a Costco or a Trader Joe's in it, obviously that's a much safer investment and is going to sell at a much lower cap rate than if you bought a property with a bunch of mom and pop tenants in it. So let's run the formula taking a simple example of a property that was earning $100,000 and we divided that by a sale price of, let's say, $2 million. That would mean that the property is selling at a 5% cap rate. So if I show it to you like this on a property that's generating annual net operating income of $100,000, you can see that each 0.25% drop in the cap rate really affects the purchase price, makes it jump up. So now that you understand how cap rates work, you might still be wondering, how do I know what cap rate to apply to a property that I'm thinking about buying or selling? Who determines that? The answer is the marketplace determines it. So let's say that there's this Walgreens property in California that you're interested in writing an offer on and you're not sure where to start. Of course, the first thing you're going to want to do is you're going to want to find out the average cap rate that Walgreens properties in California are going for. So if we do a quick search for properties that are for sale in California with a single tenant Walgreens, we see that the average cap rate is about 5.5%. There's actually one at the top of the list. Now that one has a much lower cap rate, but that's because that one is a ground lease, which means it's a much safer investment, because when the original landlord or developer signed the lease with Walgreens, they were just leasing them the land, and Walgreens paid to have their own building built. So now if they ever went out of business after you buy this property, they have to leave the building there, obviously. They're not tearing it down before they leave, and therefore you're getting the property back at a much higher value than when the lease was originally signed with Walgreens. Now you have an improved property, whereas before the original owner was just leasing them the land only. So that is a much safer investment. You actually will be able to obviously collect much higher rent than Walgreens is scheduled to pay, because you'll be able to lease it as a fully improved property, not just a piece of land. So that's a very, very safe investment, and it's going to have a very, very low cap rate. The other ones are like I said, about 5.5 cap, and those are just regular single tenant leases, not ground leases. Now you're actually going to want to look at sale comps as well, meaning actual comparables of what properties sold for in the last 2 years. So I'd do a search of Walgreens properties in the last 2 years and see the cap rate that they sold for. These are just, of course, that we're looking at now, the asking prices based on a cap rate of properties that are currently on the market. But it's more important to look at what the actual sale comps went down at. Hopefully you enjoyed this video, and if you did, please don't forget to hit the thumbs up. And if you have any questions, you could always write to me in the comments section below, and I'll get back to you as soon as I can. And thank you for watching. Have a great day.